So as Paul said, I'm going to talk about what happened to the headline public finance yesterday in terms of that pretty large forecast improvement and that equally large increase in spending. So while a lot of things did change yesterday, actually some things look pretty much the same as they did in March. So firstly, if we look at the economic forecast, the medium-term outlook is still pretty sluggish. Real growth in the final year of the forecast is only set to be 1.6% in real terms. That's really pretty poor relative to what we've been used to historically. And this is largely because the OBR's pessimistic view of productivity remains. There was a small improvement in the economic forecast from better employment numbers, but the big picture on the economy is that it's still a sluggish outlook, not much change from March. And actually looking at borrowing in the medium term, you might think that not much had changed either if you just looked at the headline public finances. This is what we were expecting the path of borrowing to look like back in March. And this is the path the Chancellor set out yesterday. And you can see that from next year, 2019-20 onwards, it's set to be pretty much at the same level as that March 2018 forecast. But note also that borrowing this year is set to be much lower, to the tune of about £12 billion. So what I'm going to do now is talk about where that £12 billion came from. So what were the improvements in the forecast that led to this lower borrowing forecast for this year? Well, as Paul said, there's no one answer, but certainly tax receipts have performed better than expected so far this year, and that's come across a whole load of taxes. You look at income tax and national insurance, VAT, corporation taxes, including both onshore and North Sea receipts, all of them are doing better than the OBR thought back in March, so they contribute together to quite a substantial increase in tax receipts. Spending is also set to be lower, to the tune of about £4.5 billion. That's again due to a number of different things, partly lower welfare spending, partly slightly lower debt interest spending. And all in all, that leaves a forecast improvement this year of about £12 billion. Now that £12 billion sounds pretty big, and actually for a near-term forecast improvement it is. If we compare it to all March to autumn forecast changes made by the OBR since it came into existence in 2010, only one of them in November 2016 has been bigger. And so what we're just showing here is the absolute change. Some of these have been reductions in borrowing, some of them have been increases, but you can see that this was a much larger than average near-term revision from the OBR. And of course, near-term revisions are perfectly nice for chancellors. They're worth a lot more if they persist into the longer term. And as the many numbers on this slide show, actually they are set to persist into the longer term. So I'm just going to focus on this final column, 2022-23, and actually all of those improvements in taxes that were set to come about this year are all set to persist throughout the forecast period, some of them becoming slightly stronger. For example, North Sea oil is expected to raise more revenue as as the oil forecast has gone up. Now that lower spending so far this year is also set to persist over the forecast period, and that means that overall the underlying change, so before the Chancellor announced any policy measures, borrowing looked about £18 billion better than it did in March. So that means if the Chancellor had chosen to do nothing, that would have left him a very small deficit in 2022-23. So I showed you that that 12 billion was very large relative to near-term changes since 2010. How big is this 18 billion? Well, really not as large. If we look at all final year underlying forecast revisions that the OBR have made since 2010, again looking at the absolute change, so some of these have been improvements, actually more of them have been worsenings, you can see that this is only just above average. It's not even the largest change that this Chancellor has experienced. He actually got a larger revision both in November 2016 and November 2017, but they both went in the wrong direction, whereas this one is actually the second largest improvement that the OBR has announced since 2010. So that means that if the Chancellor had not announced any measures yesterday, then the deficit would be declining pretty quickly, reaching that small deficit in 2022-23, and actually he would be forecast to have a small surplus in 2023-24, reaching his fiscal objective of eliminating the deficit by the mid-2020s, at least 1 year early. And yet we know that the final path for borrowing was pretty much slap bang on top of that March line, and what that means for the Chancellor is that things got a lot better and he decided to give it all away. So what I'm now going to do is think about where that giveaway has come from. So I'm going to think about how that surplus, if the Chancellor had announced nothing in terms of policy in 2023, became a deficit of about £20 billion. Now, there are quite a lot of scorecard measures on tax. There were some takeaway measures and some giveaways that actually, in the final year of the forecast, pretty much even out completely. As Chancellors tend to do, they announce the giveaways that take effect sooner, whereas the takeaways take longer to take effect. So, for example, the freeze to fuel duty, changes to the personal allowance and higher rate thresholds, temporary increases to capital allowances, they're all front-loaded. But the real story here is on spending. There are a couple of very small measures that were spending takeaways, but really this was a budget that was all about that very large spending giveaway, much of which went to the NHS. Ben's going to talk in more detail about public service spending later on. Now, there are some other things going on in this forecast, some non-scorecard measures that the government didn't take account of. Actually, the spending giveaway was so large that it had macroeconomic consequences as well. The economy in cash terms was set to be larger in 2023 as a result of the measures announced by the government. That means higher tax receipts, so that actually contributes towards lower borrowing, and that leaves that deficit of about £20 billion in 2023-24. So we've seen tax receipts doing better than was forecast previously, but that's not really driven by a larger economy. We've seen a large increase in spending, so where does this leave us in historic perspective? Well, if we look at the total amount of receipts that the government receives as a share of national income, well, that's set to be reaching its highest level since 1986-87. If we isolate the element of that that's due to taxes, then that's actually reaching its highest level since the late 1960s and is set to be maintained at a level that we've not maintained since the early 1950s. And what about spending after that very large increase announced by the Chancellor? Well, it's still set to be its lowest level as a share of national income since 2003-04. Now, the Chancellor talked quite a lot yesterday about the headroom that he had against his fiscal rules. And that's certainly correct in one respect. He has a fiscal rule that requires that structural borrowing, that is borrowing after taking into account the temporary strength or weakness of the economy, must be below 2% of national income in 2020-21. He has headroom of about £15 billion relative to that target. But actually, he has another fiscal target as well. He has a fiscal objective that requires him to eliminate the deficit entirely by the mid-2020s. And yet in 2023, he's still set to have a deficit of £20 billion. And actually, the deficit's hardly falling at all across this entire forecast period. So rather than having headroom against that target, there's still more work that he would need to do if he were to be on course to meet that target. Now, the Chancellor suggested that some of this £15 billion headroom could be used if and when the government reached a Brexit deal. And this was sort of part of his two-pronged Brexit deal dividend. The second was the idea that if the government were to get a better-than-expected deal, that would lead to the economy growing more quickly and therefore would give him capacity to increase spending further. And it's certainly true that if the government were to reach a deal that was better for the economy than the current OBR forecast suggests, that would be good for the public finances. That wouldn't mean that Brexit was positive for the public finances overall, but it might go some way to offsetting the £15 billion worsening that the OBR set out in its immediate post-referendum forecasts. But while a better-than-expected deal could be a boon for the Chancellor, of course a worse-than-expected deal or a no deal would lead to forecasts going in the other direction. And I don't think we would expect, and certainly in the case of a no-deal scenario, that taxes would be increased or spending reduced immediately, that wouldn't be the appropriate short-term response. But certainly in the longer run, it would likely mean further fiscal consolidation required. Now, there's another type of Brexit dividend that actually the Chancellor didn't mention yesterday, and that refers to the direct contributions that the UK makes to the EU, net of what the EU pays in the UK. And actually, over this spending review period, there's good reason why the Chancellor didn't mention it. It actually won't really deliver a saving at all once you take into account divorce payments and any necessary extra public spending to implement Brexit. So it's worth considering how our forecast for borrowing compares to pre-referendum forecasts. And the last forecast made before the referendum was in March 2016. And actually borrowing for this year is set to be pretty much bang in line with what was forecast in March 2016. But from next year, the paths diverge dramatically. In March 2016, that's only 2.5 years ago, we were expecting to have a £10 billion surplus next year. Now we're expecting the deficit to actually increase next year for us to have a deficit of over £30 billion. And of course, a lot has happened between these two forecasts. There have been two substantial downgrades, first in the post-referendum forecast, then the productivity downgrade. But there have also been large fiscal giveaways announced by the Chancellor, and his approach to forecast improvements and forecast deteriorations have not exactly been balanced. So I've already showed you that this forecast led to, the underlying improvement in the forecast led to a large reduction in forecast borrowing, and that there have been two other occasions when the Chancellor has faced large changes in the underlying public finances, in November 2016 and November 2017. And I've also showed you that this year the Chancellor decided not to change borrowing at all. That's what that cross represents. He chose to entirely spend all of the windfall, leaving borrowing virtually unchanged. Is that how he treated the forecast changes when they went in the other direction? Well, actually, in those cases, policy actually acted to increase borrowing in the medium run rather than reduce it. And if the Chancellor were to continue to behave in this way, to completely spend any windfall, to not offset any forecast deterioration, this would lead to a deficit that was ratcheting up over time, an increase in forecast borrowing. And why do we worry about increases in the deficit? Well, largely it's because that will impact on national debt, and while the deficit is back to pre-crisis levels, debt certainly isn't. So this was the forecast for debt back in March 2018. The October 2018 forecast announced yesterday implies debt falling slightly more quickly, but once we exclude the temporary impacts of a Bank of England scheme, really it's looking pretty flat, staying stubbornly high, far above those pre-crisis levels over the medium term. Now, how should we expect debt to fall over the even longer term, say over the next 50 years? Well, if we take into account the OBR's forecast for the economy, projections into the longer term, and we assume that the government isn't actually going to eliminate the deficit, given that the Chancellor had that opportunity yesterday, he chose not to, and perhaps the best we can expect is a deficit of around 0.8% of national income, which is what we're set to have in 2023, well then that would see debt falling over time, but it would still be over 60% of national income in the late 2030s. And this smooth profile doesn't take into account the fact that nasty fiscal shocks tend to come along. So on average in the UK, we get a recession about once every 10 years. If we assume that when a recession comes along, it leads to the debt to GDP ratio increasing by about 10 percentage points, then actually only running a deficit of this level in good times could lead to debt being on an unsustainable upward path over time. What if the Chancellor had instead chosen to bank his forecast improvement, not given all of the money away, and say that had been maintained into the longer term? Well, then you get debt falling more quickly, whether or not you take into account this illustrative impact of recessions. So to conclude, there was a substantial forecast improvement announced yesterday, particularly large in the short run, less big in the longer run, despite the fact that the economy forecast is broadly unchanged. And the Chancellor took the decision, given this very large windfall, that he wanted to spend all of it, mainly on higher NHS spending, He's also talked about the possibility of even more spending in the event of a good deal. And this reflects the Chancellor continuing this pattern of responding differently to forecast improvements and deteriorations. That's also a pattern that we've observed since 2010. And if the Chancellor does want to eliminate the deficit entirely, it seems fairly unlikely at this point that this target will be met, but if he were to meet it, then on these plans, he would require further consolidation. I'm now going to hand over to Helen, who's going to talk in more detail through some of the tax measures that the Chancellor announced yesterday.